December 9th, 1999. A company opens for trading at $30 per share. 8 hours later, it closes at $239. That's a 698% gain in a single day. The biggest first-day IPO pop in history. The company is called VA Linux. It sells software that's available for free. Anyone can download it. Anyone can use it. VA Linux just packages it and sells support services. Here's the part that should make you uncomfortable. The people buying this stock aren't stupid. They're professional investors. They manage billions of dollars. They understand the business model. They know the software is free. And they're buying anyway. This is the story of how an entire market convinced itself that reality didn't matter. How fear of missing out became more powerful than fundamental analysis, and how the psychology of crowds can make smart people do completely irrational things. Because the scariest part of market manias isn't that they happen. It's that when you're inside one, they feel perfectly rational. December 9th, 1999. 9:30 a.m. VA Linux is about to start trading. The opening price is supposed to be $30 per share. That values the company at $2 billion. The company has $44 million in annual revenue. It's losing money. The software it sells is free. None of this matters. Imagine you're a portfolio manager. You manage $200 million. Your clients are calling. They're asking why you didn't get shares in the IPO. Why aren't you in the tech stocks that are doubling every week? Your competitor down the hall, he bought theglobe.com last month. It's up 400%. He bought MarketWatch 2 weeks ago. It's up 500%. He's having the best year of his career. You're sticking to your fundamental analysis, finding companies with actual earnings, growing portfolios at 15% per year. That used to be excellent. Now it looks like you're missing the biggest opportunity in history. This is how market manias start. Not with stupidity, with fear. Psychologists call it FOMO, fear of missing out. But it's more than that. It's the fear that everyone else has figured out something you haven't, that you're the only one who doesn't get it. Let's examine how this works. You see VA Linux opening at $30. You know the company loses money. You know the software is free. You know this doesn't make sense. But then it hits $50. Then $70, then $100. At $100, you have a choice. You can watch from the sidelines and feel smart when it crashes. Or you can buy and feel smart when it goes higher. Here's the problem. If it goes to 200 and you didn't buy, you look like an idiot. If it crashes to 50 and you did buy, well, everyone else bought too. You were following the consensus. This is the psychology that drives market manias. The pain of missing out is greater than the pain of losing money with everyone else. So you buy. At $100, then $120, then $150. Because everyone else is buying. Because the stock keeps going up. Because not buying feels worse than buying. By 4 p.m., VA Linux closes at $239. You made money. Your clients are happy. Your competitor who bought at $30 made even more money. The only question is, what happens when everyone tries to sell? Let's talk about momentum. It's the most powerful force in market manias, and the least understood. Momentum means buying things because they're going up, not because they're valuable, not because they're cheap. Because they're going up. Here's why it works. When a stock goes up, it attracts attention. More attention means more buyers. More buyers means the price goes up more, which attracts even more attention. VA Linux on December 9th opens at $30, hits 50 by 10 a.m. That's a 67% gain in 30 minutes. CNBC covers it. Bloomberg writes about it. The Wall Street Journal will mention it tomorrow. By noon, it's at 120. That's 300% in 3 hours. Now it's the lead story. Every trader is watching. Every portfolio manager is getting calls from clients asking if they should buy. The stock isn't going up because the company got better. The company is exactly the same as it was this morning. The stock is going up because the stock is going up. This sounds insane, until you realize it works. For days, sometimes weeks, sometimes months. Let's examine why smart people participate in this. Because they do. The smartest people on Wall Street, the best analysts, the most experienced traders. Here's what they tell themselves. I know this is overvalued, but momentum can continue longer than fundamentals would suggest. I'll write it up and sell before the crash. Everyone has the same plan. Everyone thinks they'll sell before everyone else sells. Everyone thinks they're smarter than the crowd. But mathematically, this is impossible. If everyone wants to sell at 200, there's nobody to sell to. The price doesn't slowly drift down from 200 to 190. It gaps down to 120, then 80, then 50. The first person to sell at 200 gets 200. The last person to sell at 200 gets 50. The difference between the two is about 3 seconds. Economists have a name for this. The greater fool theory. You buy at a stupid price because you think a greater fool will buy from you at an even stupider price. Here's what makes market manias psychological. Everyone knows this is how it works. Everyone knows they're playing greater fool. And everyone thinks they're smart enough to win. VA Linux hit 239 on December 9th. Within 3 weeks, it was at 180. Within 3 months, it was at 90. Within a year, it was at $7. So who were the fools? Everyone who bought above $7, which was almost everyone. Let's talk about the collective delusion, the stories people told themselves, the rationalizations that made it all seem reasonable. January 2000. VA Linux is trading at $200 per share. The company is worth $9 billion. It has $44 million in revenue and is losing money. Here are the stories analysts told. Linux is the future of computing. Open source will dominate. VA Linux is positioned perfectly. The revenue isn't the point. The ecosystem is the point. Let's examine these claims. Linux was indeed growing fast. Open source was becoming important. These facts were true. But how do you get from Linux is growing to VA Linux is worth $9 billion? Here's the reasoning. If Linux becomes dominant, companies will need support. VA Linux provides support. Therefore, VA Linux will capture enormous value. This logic has 3 flaws. First, Linux is free. Anyone can provide support. There's no barrier to entry. Second, most Linux users are technical. They don't need much support. Third, even if support becomes a billion-dollar market, why would VA Linux capture most of it? These are obvious questions. But during a mania, obvious questions feel like missing the point. Here's what happens in your brain during a market mania. You experience cognitive dissonance. The stock price says the company is valuable. Your analysis says it's not. One of these must be wrong. Your brain has 2 options. Option 1, the market is wrong. Option 2, you're missing something. Most people choose option 2, because the market includes thousands of smart people. You're just one person. Probably they see something you don't. So you look for reasons why the high price makes sense, and you find them. Because you can always find reasons if you look hard enough. Linux is growing at 200% per year. VA Linux has partnerships with major companies. The CEO is brilliant. The team is experienced. All of these things can be true, and the stock can still be wildly overvalued. But during a mania, pointing this out makes you seem like you don't understand the new paradigm. People who questioned the valuations in late 1999 were called dinosaurs. They didn't understand the internet economy. They were stuck in old ways of thinking. They would be left behind. Within a year, the dinosaurs looked smart. But in December 1999, they looked foolish. This is the psychology of market manias. Being right too early looks exactly like being wrong, and looking foolish is scarier than losing money. March 10th, 2000. The Nasdaq hits 5,048. It's the peak. Within 2 years, it will lose 78% of its value. VA Linux is trading at $92, already down from the $239 high, but still worth $5 billion, still making no profit. What changed? The psychology. Suddenly, the questions that seemed irrelevant in December became urgent in March. When will you be profitable? How do you compete with free software? What's your sustainable competitive advantage? The answers were the same as they'd been in December. The company didn't know when it would be profitable. It competed by providing support for free software. Its competitive advantage was unclear. Nothing about VA Linux changed between December and March, but everything about market psychology changed. Here's how crashes work psychologically. They're the mirror image of manias. During a mania, everyone wants to buy. During a crash, everyone wants to sell. The difference is speed. Manias take months to build. Crashes take days. Fear is faster than greed. When things are going up, you can wait. Maybe you'll miss a few percent of gains. When things are going down, every second matters. VA Linux hit $92 in early March. By mid-March, it was at $70. By April, it was at $40. By December 2000, it was at $7. From peak to December 2000, the stock lost 97% of its value. $9 billion in market value disappeared. Employees who got stock options at $200. Worthless. Investors who bought at $100. Lost 93%. The founders who held most of their shares? Lost billions on paper. Here's what people told themselves during the crash. I'll hold on. It will come back. The fundamentals are still good. This is just a temporary panic. VA Linux never came back. The stock traded below $10 for years. In 2009, the company changed its name, tried to distance itself from the mania, eventually got acquired for a fraction of its peak value. Why didn't people sell at 200, at 150, at 100? Because selling meant admitting they were wrong, and admitting you were wrong felt worse than losing money. This is loss aversion. Humans hate losses more than they love equivalent gains. Selling at a loss makes the loss real. Holding means there's still hope. Hope cost most people everything. Here's what makes market manias fascinating. They're not caused by stupidity. They're caused by psychology that makes perfect sense. Fear of missing out is rational when everyone else is making money. Momentum trading is rational when momentum continues. Following the crowd is rational when the crowd is right. The problem is knowing when these rational behaviors become irrational. And you can't know while you're inside it. Market manias have happened throughout history. Tulip bulbs in 1637, South Sea Company in 1720, railways in the 1840s, radio stocks in the 1920s, .com in the late 1990s. Every time, smart people convince themselves this time is different. Every time, the psychology is the same. Fear of missing out. Momentum. Rationalization. Collective delusion. Today, we see similar patterns. Stocks trading at valuations that require perfect execution. Companies worth billions without profits. Narratives about new paradigms. Are we in a mania? You can't know while you're inside it. That's the nature of market psychology. When you're living through it, it feels rational. The psychology of market manias isn't about stupidity. It's about incentives. When everyone else is making money doing something stupid, being smart looks like the stupid choice. VA Linux went from $30 to $239 in 8 hours. Then from $239 to $7 over 18 months. The people who bought at $200 weren't idiots. They were responding rationally to psychological pressures that made buying seem less risky than not buying. That's the terrifying part about market manias. The psychology makes sense, the incentives make sense, the behavior makes sense, right up until the moment it all collapses, and by then, it's too late. VA Linux, first day gain 698%, peak market cap $9.5 billion, current value acquired for under $200 million. The psychology of market manias, perfectly rational until it isn't.